Hello friends, this is Raj Sastry from Raj Option Trading. Today is June 5th, 2021. I want to cover stock and option trading ideas for the week of July 6th, 2021. So we will look at John Cotter's TTM Squeeze indicator that will really help you to buy stock or call option. We'll primarily look at the long side of the trade, not the short side in this segment. So with that, let's jump in here. Folks ask, what is TTM Squeeze? So TTM Squeeze is a volatility and a momentum indicator introduced by John Carter. So it's a great indicator. I use it quite a bit. So it capitalizes on the tendency for the price to break out strongly after consolidating in the tight trading range. Have you ever seen a stock that kind of moves in the trading range for a long time? You feel like your money is a dead money at that point. So with this TTM squeeze, you don't need to really wait for the long trading range activities. Instead, you can look at when the stock is going to break out of its trading range, and then you can place your bet and buy some stock or options. So that's the great advantage of this. You can basically cut down on the waiting cycle and look for some of the swing trading opportunities, whether you are a daily trader, weekly trader, or a monthly trader, or even a longer term trader. Squeeze indicator measures relationship between two studies. One is Bollinger Band, other one is Keltner Tunnel. So you really don't need to look at these very carefully, because the squeeze looks at both these bands and helps you out and tells you when is the right time to buy. So when the volatility increases, so does the distance between the bands. If you look at the Bollinger Band, when the volatility increases, the distance between the band also increase. Conversely, when the volatility declines, the distance between the band also declines. So that's a great way to understand Bollinger Bands. It tells you the distance between the bands and the relationship to volatility. And the squeeze takes advantage of quiet period in the market. Look at a stock that's quiet for a long time. Squeeze kind of understands what's going on here. It takes advantage of the quiet period. When the volatility decreases significantly after the and market is building up the energy for the next move, higher or lower. So this is what happens. Typically, a stock stays in the trading range for a long time. Because it's in the trading range, the average true range or ATR gets reduced, and volatility will also get reduced because market is not expecting too much uptick or a downtick at this point. So that's when this squeeze indicator kind of understands what's going on in the market and tries to identify when the market or the stock in this scenario is about to break out of its trading range. So with that, let's go into a little more detail here. The quiet periods are identified when the Bollinger Bands narrow in width to the point they actually go inside the Keltner tunnels. So that's when you understand it's really a quiet period. Something is bound to happen. Market cannot stay this quiet for long. So when this happens, when the Bollinger Bands narrow in width and they go inside the Keltner channel, that marks the period of reduced volatility and signs that market is going to do something here. It's building so much momentum here, it's going to break on the higher side or the lower side. The trade signal occurs when the Bollinger Band then move back outside the Keltner channel. So this is when the trade signal happens. So this indicator tells you when is the trade signal happening. And the red dots indicate tight compression of the volatility. When you see a lot of red dots in this TTM squeeze indicator, that tells you, hey, you know what, right now the Bollinger Band is inside the Keltner tunnel and the volatility itself is pretty low. So that kind of tells you, hey, that's this is going on at this time. Be careful. Look for next green dot here. That tells you which side energy might get released. So the first red dot after a series of first green dot after a series of red dots indicate that energy is ready to be released. That kind of tells you, what, there's something going to happen at this point. This stock is not going to stay in the trading range anymore. So that's the indication for you. The first green dot is the indicator or the signal. So if the oscillator, typically we look at a longer term C wave. We look at it as we go into Thinkorswim in a minute. If the long term oscillator, which is a C wave, if that's above zero, when this first green dot comes, then you go long, meaning you buy stock or call option or call spread. But if it is below zero, then you can go short, basically buy some put options, or go short, meaning you can even short the stock. Shorting the stock itself, unless you're an experienced trader, I would not recommend. But you can look at and buy some put options. That's a better idea. Or you can even buy some put spreads if you want to. So that's in a nutshell what's the TTM squeeze indicator. As I go through the Thinkorswim, I will also illustrate some of these things so it sticks in your mind. So with that, we have some more indication here. There is a wave. A wave measures short-term trend. Once A wave crosses above zero, it's a bullish sign. So A wave has a yellow bar, which is bullish, and a red bar, which is bearish. So the moment you see yellow bars, stock is getting bullish at that point. And conversely, when you see a red bar, it's a bearish. There's also a C wave. It's a longer term trend. If the C wave is light blue bar, then it's bullish. If it's a dark blue bar, then it's a bearish. So it kind of tells you pictorially or visually what's going on here. And TTM wave study represents combo. In Thinkorswim platform, there is a wave, and then there is a C wave. So you can also look at and have both these waves in your chart. That will help you. And you can also look at my chart setting video that tells you how to set up the A wave and C wave in Thinkorswim. The best squeeze are the ones which fire off in the direction of C wave. For example, the moment you see a green dot after a series of red dot, and if the C wave is above zero, and if it's bullish, then you have the best squeeze. Basically, to squeeze in the direction of C wave. In this case, if the C wave is above zero, it's going to fire on the bullish side per John Carter. Obviously, nothing is 100% sure shot. That's where you kind of look at, a couple more indicators if you want to, and make sure you don't look at this just by looking at TTM wave. But TTM wave will be a good identifier, a good indicator that tells you whether you can go short or go long. So with that, let's jump in here and look at the stocks here. I will just quickly go through this chart so you understand what's going on. So this is as of July 5th. So as you can see here, I got the stock here, the name, the price, the market capitalization, sales. Sales and sales growth are very important for any company. And the stocks with the bolded here, IBM, Digital Turbine, so on and so forth, all the bolded rows here, those indicate there is a quarterly positive sales growth here, a little bit stronger candidates as you can think of. And then you got gross margin, very important for a company to have positive gross margin. I really like double digit or higher double digit gross margin. Then you got institutional ownership that tells you there are big mutual funds and the hedge funds are supporting this company. And then you got short ratio. Anytime you see a short ratio above 10%, for example, American Airlines 14%, and as you scan through here, OPK, Opco Health 13%, Fisker 23%. These might give you some good opportunity. With a short squeeze, stock can go up if you time it right. And then we got the price to sales ratio tells you a valuation perspective, it's expensive or not. For example, here in this chart, I think apps, which is a Digital Turbine, has got a 20 20 price to sales ratio. It's not too bad for a SaaS company, but generally if you see more than 30, 40, you have to be a little bit understand there is a valuation concern here. Next three indicators are your percentile. Next two indicators are your percentile and RSI, which are technical indicators. IV percentile will tell you whether the volatility is low or high. Many times, in the TTM squeeze indicator, normally volatility is lower because, it really looks for quiet periods as we talked about. But as you scan through here, one of these company here, Prevention Bio, it's got 100% IV percentile. Probably that's a not great, stock for a TTM squeeze type, setting. Then we got RSI. A high RSI tells you stock is overbought. You could probably shy away from buying at that time, wait for a pullback. Whereas a low RSI, below 55 or so, that indicates stock is oversold at this time and it's okay to buy at this time. And then we got volume. So this chart, I got the top volume as of Friday. As you can see here, company at the top is the highest volume, and then it's a descending order. Next three or next four, columns here indicate the TTM squeeze per John Carter. The first one is really one-day chart. It tells you in a one-day chart, do we have a squeeze forming? For example, CVE, there is a squeeze forming here. We got a bunch of red dots in the chart. And then we got 3-day here, tells you in the 3-day chart, do we have a squeeze forming? And so on and so forth in a week and a month. Then we also have earnings rate. We got to understand when is the earnings for the company. Typically around the earnings, the stock can be volatile. This is when you look at past earnings and see what's going on. Then we got performance here. We got 1 month performance, 3 month, 1 year, and also look at difference between the 52-week high and the current stock price. Tells you if the stock is already on the top 52-week high or is there more room to run. So that's how this chart is organized. And I also have few rows here, as you can see, highlighted in green background. The rows in green background like IBM, Wells Fargo, apps, which is Digital Turbine, and so on and so forth. These are the candidates where we have a squeeze formed, meaning there's a red dot like we talk about, and the longer term C wave is above zero. These are the candidates for you to go long, buy stock itself or buy call options or call spread. So with that, let's take a look at a couple of examples here. First is IBM. I will go to Thinkorswim chart here. So if I go to IBM here, and if you look at this chart here, as you can see, IBM has been doing nicely. Down here, went up, came down a little bit, went up. Every time there is a dip here, that's always a good opportunity to buy. And people always worry about IBM. Some think it's an old dinosaur type company. It does not know how to play the cloud, but some think it's going to come back. The way I feel it really, IBM, I think it's really trying to transition out from old company to a new company, and they want to do a lot of things on the cloud. And clearly, they have a new CEO, Arvind Krishna, who understands the cloud transition. That's a good thing. And the stock right now, as you can see here, broke down last Friday, mainly because the CEO, the president of the company, who came to this company through Red Hat acquisition, he's leaving the company. That's why stock has fallen off. He was looked upon as a, successor, for a CEO role, but he's leaving the company. That's why stock kind of came down pretty hard. So, anytime stock comes down this pretty hard, we should ask the question, hey, should we buy IBM at this point? Stock has fallen off below its 9-day, 25-day, 50-day moving average. And as you look at some of the technical indicators, I think many of you want to understand technicals. We got on the balance volume here. On the balance volume kind of tells you, hey, what's going on? On the up days, is the volume high, or the low days volume is high. Typically, when the on the balance volume goes up, that's a good indication for you. Hey, there is some bullishness going on here. You could go long on the stock. And then we got RSI here. RSI is, again, it's a channel or an oscillator. If it goes up here, say, in this case, above this line, 70 line, that tells you it's oversold. Overbought. You got to be a little bit careful and don't enter and buy when it's overbought. Instead, wait for an oversold position, which is really a stock RSI below 50 or so. That's when you can enter and buy the stock. And as you can see here, again, it became over bought here, and stock promptly came down, and right now it's completely oversold. As you look through this chart, this level of overselling happened back here. That was a good buying opportunity. Happened over here. That's a good buying opportunity. So that's why I feel like, you know what, this is a good opportunity here. With the CEO Arvind Krishna and the IBM leadership, they can go past this current setback. So that's why I feel it's a good story. Then we got DMI. DMI is one of the great indicators. I always try to look at DMI and understand what's going on. So whenever you see the red line in the DMI chart going above the blue line, that tells you, hey, there is a bearishness going on, watch out. And when the blue line here comes below the red line, same story, there is a bearishness going on. And you should also look at the distance between the red line and the blue line. As an example, somewhere here, as you can see here, we got a bullish crossover where the blue line crossed over the red line here, and the distance became more and more. The moment the distance between the blue line and the red line becomes more, that's when the stock is in the nice bullish territory. But as you see, the distance between the blue line and the red line, if it is decreasing, that's when it's a little bit bearish signal. And right now, the red line crossed over the blue line. Clearly, it's a bearish sign at this time. This happens when the stock drops like this, very normal. When the stock drops like this, the chart is very ugly. That's when traders like us, even some of the long-term investors, you could jump in and buy some and hold it for a long time. Next, we look at the historic volatility versus implied volatility. Historic volatility is the pink line, as you can see here, and implied volatility is the blue line. So anytime you see implied volatility is going over the historic volatility, that indicates stock is becoming a little more volatile at this point. So if you are a option person, you should kind of look at this itself. How is the implied vol doing with respect to historic vol? Is it above historic vol, meaning the blue line above the pink line, or is it below the historic vol, meaning the blue line below the pink line? So you should also look at the implied vol, IV rank as we call it. If the IV rank is above 50, probably you don't want to buy the call options because those are expensive. But if the implied vol is below 50, or even below like say 30 or 40, then you can buy the call option. You're okay. You're not paying too much. And in contrary, if the implied vol is above 50, you could look at some of the techniques like selling premiums. For example, you could sell some put options below the current stock price, or you can sell some call options above the stock price. Those are some techniques you can follow and go from there. And last but not least is the check-in money flow indicator that tells you what is smart money doing. For example, right now smart money is going out of the stock. Very typical. When the stocks drops off like this, smart money kind of goes down, but normally it's a good time to buy. As you look through here, somewhere down here, stock kind of dropped like anything. Smart money also came out, but see here, after a while, smart money started to come in. So this is when folks like us, we can understand what's going on, understand stock has dropped a lot, smart money is coming out. We could be ahead of the curve and buy some of these good companies before the smart money picks up again and starts buying the company. So with that, now let's jump into TTM squeeze indicator from John Carter. So if you look at IBM here, as you scan through this, we got a 1 year 1 day chart and a 2 year 3 day chart. We got a 5 year weekly chart and a 10 year monthly chart. Normally, it's good to look at multiple time frames. Even if you are a swing trader, it's good to look at multiple time frames, so that way what's going on in the stock from a longer term time frame. And also look at, when you look at the daily chart, look at maybe a 1 year chart, 1 day. As you can see here, I've increased the time interval. It's a 3 day here, it's a for one, it's a weekly chart here, it's a monthly chart here. You'll kind of know what's going on in these time frames, so it will give you a good idea. Normally, if you're a technical trader, you always want to trade in the longer term horizon picture. For example, if the stock is going up in the longer term, you would initiate a bullish position. But if the stock is going down in the longer term, you would initiate a bearish position. So with that, now let's look at IBM here. In the 3 day chart, we got a squeeze formed here. As you can see here, red dot. This red dot here indicates the Bollinger Band is now narrow and it's within the Keltner channel. So that tells you market is becoming quiet here. There is something bound to happen at this time. And if you look at the shorter term A wave, this is the shorter term A wave. That's basically telling you, hey, what, shorter term there is some weakness going on, indicated by the red lines below the zero line here. The oscillator itself is below zero. That tells you in the shorter term, from an A wave perspective, there is a weakness going on. But if you look at the longer term A wave, as we talked about, longer term A wave, we got the light blue bars here, clearly above zero. That tells you, what, don't worry at this point. You can buy stock or you can buy call options, because we got this longer term wave, which is A wave above zero. And as we scan through here, we got a weekly chart here. On the weekly chart, we got longer term wave above zero, and it's a little bit bearish. As you can see here, it's a dark blue. And in the 10-year monthly chart, we got longer term wave. Right at this point, it's above zero. So with this, according to John Carter's methodology, you could slowly initiate a buy position for this and go long. So with that, now let's go into trade chart here. As you look at the option chain here, if you're a stock person and not an options person, you could initiate a buy position here. You could buy some stock here at 140.443, confirm and send. You will end up paying around $14,000, which is good if you want to go long. But if you want to play options world here, I suggest go like at least 3 months out. 102 days is good, or you could even go longer, 137 if you want to. And understand, stock is at 140 all-time high, or 52-week high is 152, and 52-week low is 105. So it's somewhere between high and low at this point. So if you're an option person, you could go here and look at maybe delta 70. As you scan through this here, let me go to 102, 102 days out for expiration. So if you look at here, I would probably go around delta 70. Delta 74 is good enough. I would buy this right here. So I'm buying one call option for strike price 130, expiring on 15th of October. We have 102 days out, in future for this to expire. I could confirm and send like this. My profit potential is infinite, as you can see here. If the stock goes above 142.45, which is about $1.40 above current stock price, I will break even. If the stock goes below this break even point, I will lose my entire premium that I paid, which is 1245. So I could confirm and send this. This is one way to play. So if you do something like this, you are banking on IBM to go up, and you will make a nice money. Every time IBM goes up by $1, you will make 72 cents, because as you can see here, we bought a delta 72 stock, delta 72. That's why every time IBM goes up by $1, you would make 72 cents. So with that, this is one way to play. And if I go down here, you'll see here delta is 74. As IBM goes up by $1, you will make 74 cents because you bought the option. So if you don't want to play, if you don't want to pay so much money, you could also do a option spread. For the option spread, we call it in-out spread. You'd buy in the money call and sell out of money call. Stock being at 140, I would sell a 135, 145. I would buy a 135, 145, as you can see here, and um, there you go. So I pay $4.90 for this spread, and if I confirm and send, I make $5.10. The way to understand this is really it's a $10 wide spread. 140. I bought 135. I'm selling 145. $10 wide spread. So I paid $4.90, and remaining portion of $10 is $5.10. That's your profit potential. So that's one way to understand whether to go for this spread or not. This has got good risk reward ratio. If I lose 490. If I make, I'll win $510. And if the stock is above 139, which is below current price, I break even. So it's a good proposition, and obviously you don't need to wait till expiration date, which is 15th October. You could sell this anytime for a profit, or you could close the position for a small loss. It's really up to you. It's valid up to 15th of October. This is one way to play. Normally, folks do this because it's a risk wise, it's less risk, and typically it's a little bit conservative strategy. So with that, let's jump back in here, look at one or two more stocks here. One of my favorite is APPS, Digital Turbine. As you can see here, Digital Turbine is a $68 stock. Nice sales growth. As you can see here, it's down 33% from 52-week high. And let's see if it's a good time to buy Digital Turbine. As you can see here, we got a 3-day squeeze here. We can see if it is worth investing. So with that, let's go back to Thinkorswim here, ticker symbol APPS, Digital Turbine. Stock is $68, all-time high is 102, and all-time low is 52-week low is $11.75. As you can see, it's got quite a range. It's in a 52-week time period. So with that, let's go into the chart here. We got apps, Digital Turbine. As you can see, a stock is pretty nice looking chart. I love this type of charts here, doing nicely. And we got a big candle, as you can see here. In Friday, I think it came down drastically. Folks are a little bit worried about the valuation. And as you look at the volume here on the balance volume, nice acceleration. I love this. It's a great indication the stock is really having some nice momentum. And from a RSI perspective, RSI is down here at 44. Anytime RSI is down like this, always a good opportunity to buy some of this great company. As you look at this company here, RSI went all the way up here, and as you can see, there is a small pullback. But again, it went oversold again or overbought again, came down. Whenever it's above here like this red overbought, you don't want to buy at that time. You could rather wait a little bit, wait for a good entry point and then buy. So that's always a good idea. Sometimes secular growth stocks, they will be overbought for a long period, but you can always wait for a small pullback. So with that, if you look at DMI here, clearly right now there is a bearish crossover, meaning red line crossed over the blue line. There's a bearish crossover. And implied wall, as you can see here, it's increasing a little bit. And if you look at the IV percentile here, 34.3, anytime IV percentile is between say 45 or so or even 40, that's a good time for you to buy call options, because you're not paying too much premium for the call option. And as you look through here, check-in money flow perspective, money is kind of flowing out of the stocks. Understandable, because whenever there's a big candle, down candle like this, stock came down by $9 on Friday. Typically, chart gets ugly pretty soon. So this is when we kind of see what's going on. Should we go buy at this point or not? So now let's jump into John Carter's TTM squeeze indicator. As you can see here, we got 1 day, 1 year, 2 year, 3 day, and we got 5 year weekly chart and a 10-year monthly chart. So as you scan through here in a 2-year 3-day chart, we got a squeeze forming here, a red dot that tells you at this time the Bollinger Band is compressed inside the Keltner tunnel. So momentum is building at this point, and stock is bound to go do something, significantly. And as you look at the shorter term A wave, that tells you, hey, you know what, it's bullish because you got a bullish candle or a bullish bar above the zero line here. That tells you, hey, short term it's bullish. And if you look at the longer term C wave, it's again the line, the bar is above zero, and it's a light blue, which is bullish. So with that, clearly it's a long signal. We got a red dot forming. Whenever we get a bunch of red dot, then a green dot, that tells you, hey, you know what, you could do something with it. And now clearly it's a bullish signal because a C wave, longer term C wave, is above zero line here. So with that, some folks would like to wait for a green dot to come and then take action. You could do that, or you could even buy before itself, when the signals are good like this. So with that, I would go and initiate a position here. You could buy stock outright at $68.27 by clicking on this ask here and just go buy it. You could pay 6,938, 6,938, one way to play. And if you want to buy options, I would recommend at least go 165 day here. That gives enough time, and you could do delta 70 right here, and you could pay $18.80 and buy it. And if the stock goes above $78, you'll break even. So this is where some folks will wonder, hey, what is it worth taking the risk? Because now you're paying you are paying $18, in this case 1,880, and the stock price has to at least go by $10 above the current stock price for you to break even. So if you don't want to do this, if you think it's a little more risky, you are paying too much money, you could play the spread game here. You could buy a spread. Stock is at 68. There are various ways to play here. If you're a little bit very conservative, you could do 65-70 spread, which is just a $5 spread. And if you want to do that, you could do something like this. $5 spread, you're paying $2.95 for this spread. Remaining money out of this $5 is your profit potential. If I confirm and send, so you're paying $2.95 to make $2.05. Your break-even point is below current stock price, which is $67.95. This is one way to play, but risk reward is not great. But at least you're not losing too much money. Your max loss is limited in this scenario. If you can also play a little bit longer term, wider spread here, stock being at 68. One way to play is really you could do 60 and say 70 spread, or even 60-75 spread. That could be better off. If I do 60-75 spread here, there you go. I'm paying $6.50. It's a $15 wide spread. Remaining money out of $15. That's your profit potential. So if you see here, you're paying $6.50 to make $8.50. This could be a better option here. Your max loss is $6.50. Your max profit is $8.50. You're more than doubling your money. So this is another way to play. And if I go back here, we got some great companies here. Look at the ones I highlighted in green here: IBM, apps, Alcoa, CVE, and so on and so forth. And also pay close attention to how far the stock is from 52-week high to give a good indication. And also look at RSI to tell you where the RSI is high. If it is above say 50 or 55, probably it's not a good idea. Train has left the station. But if the RSI is below 50, you could venture in and buy stock itself, or buy call option delta 70 or higher, or you could even buy spread like we talked about. And also pay attention to IV percentile. When the IV percentile is high, like prevention bio, probably you don't want to buy call options. You want to wait a little bit. But if the IV percentile is lower in most of these cases, you could easily buy the call option or call spread, or you can buy stock anytime. You don't need to worry about IV percentile to buy stock. And with that, let's jump into next page here. We got a couple more here, and I've highlighted some stocks here, regions, Tapestry, Luminar, and so on and so forth. You can look at some of these stocks here and see if it's worth buying the stock outright, or you could even do options like we talked about. American AEP, American Electric Power, I think it's a good stock here. They're down 10%. You could buy them. And even some of these companies like AI, C3 AI, there's a daily squeeze here. If you're a stock person, you could even buy some of this C3 AI, taking advantage of this downturn here, 67% from 52-week high. You could slowly build a position, even though right now there is no indication through to say it will go up. That's why it's not highlighted in the green background. So next we got one more page here. As you can see here, we got Arkimoto, Billy, one of my favorite stock here, Nova, and so on and so forth. The ones you have in the background, green background, you could look at initiating a long position here by buying the stock itself, call option or a call spread. So with that, thank you very much. Happy investing and trading. Please subscribe.